Okay, let's hope that this works. So I'm going to go through how to read this pro forma for the Humboldt unit. And this would be something you guys can use in training. And if you think this might be something to put together and actually send out to people, let me know. First page is kind of the general information on purchase, income analysis, and financial metrics. Your cap rate, 13%, is very high. Normal cap rate is somewhere between 4 and 8%. Cash on cash, 30% is extremely high. A good cash on cash is about 15%. So this was a little bit of just stuff we wrote about the unit. And we get into the purchase analysis. So now, for the sake of argument, we put this as being relatively conservative. So our expenses are a little higher, and our sale price is the list price. And I doubt we will be selling this at list price. So going down the line here, list price, this is the first mortgage, which is 75% of the list price. This is your down payment. Buying cost is miscellaneous closing costs that may be higher or lower depending on where they get their mortgage. Initial cash invested gives you a cost per square foot and then a monthly rent per square foot. This is your mortgage information down here, which is 75% loan to cost and loan to value, which means 25% down. $1 million loan, 30-year, 6%. Now, you're probably not going to get a 30-year loan on a commercial. It'll probably be a 5-year, but the interest rate at 6% is a little bit higher than market rate right now. So let's go over to income side. This gross rent of $23,000 is based on what we actually received for rent in July. So that included the Airbnb, the short terms, and the long-term leases. The vacancy loss is 8% of that number, and that's one of the financial assumptions down at this side. So the vacancy rate of 8% translates into this number here. So this is our growth, or our operating income after vacancy loss. Your expenses, we put 5 expenses in here: maintenance, insurance, management fees, taxes, and sewer and water. The taxes is a real number because it's from the tax roll. All of these other ones are estimated based upon percentages that are usual and customary. So this management, if you're not spending it every month, you're sticking it into a fund to cover, hey, the air conditioner went, hey, we need a new roof. Insurance, about $1,000 a month, is $1,000 per unit per year. Management fees, this totally depends on whether you have someone that actually manages the property for you, or if you manage it yourself. If you manage it yourself, that number goes right to the bottom line down here. Taxes, that's based on the current 2019 taxes. Sewer and water, $600 a month. Some units the tenants are paying, some units the seller is paying, but they're apartments. They don't have lawn. They're not going to be washing their cars. So, $600 a month, high or low, I don't know. Our house here in Cedarburg, for instance, is about $50 a month for sewer and water. So that would be a number we might try and get from Shrey, but again, it's not a huge number overall. So the total expenses plus taxes, is $6,000 a month, or $72,000 a year, which is 28% of your gross rent. So your net operating income is here. Now this net operating income assumes that, hey, you make $181,000 if you buy the property for cash. If you have a mortgage, that expense goes down on that line. So $62.95 for the monthly mortgage. Your cash flow is $8,800, or $106,000 a year. If you don't have a mortgage, you buy it for cash, then your cash flow is $15,000, and your net operating income, net cash flow, is $181,000. So again, going down here, these are your financial metrics. Gross rent multiplier, 5.1. Operating expense ratio at 28%, which isn't too bad. Debt coverage, because you do have a mortgage. Cap rate on your purchase is very high, and so is the cash on cash return. Keep in mind that the Airbnb model throws a good amount of profit into this that you probably wouldn't see if you were on a standard 11 units at 12-month leases. These are assumptions down here. And then this is your buy and hold projection chart. for 1 year, 2 year, 3, 5, 10, 20, and 30. And all of these numbers change over time, as well as do your expenses, your net operating income, cash flow changes over time, etc. And then obviously your loan is getting paid off. So this is your loan balance and it gets paid off after 30 years. So, and then we have some nice graphs. The cash flow goes up monthly because you have inflation. Your loan balance goes down and your equity goes up based on the fact that you're paying off the loan, yet you also have the value going up on the property by 3% per year. So after 30 years, this property would be worth, close to 3.5 million. And then your IRR, which first 2 years you get a lot of expenses, but you're looking at about 35%. So I hope this 6-minute video and explaining this sheet helps you kind of go through and be able to explain this to a client. This and the rent roll would be 2 documents we'd want to have available to send out, and then also the offering memorandum, which has a lot of other details in it. So I hope this helps.